G'day everyone, welcome to the weekly general update for the weekend of the 11th and 12th of May. Just a reminder, this is general advice only, as you've seen before. The summary of the action for the week: the S&P ended up falling by 16 points and it was a fairly negative week, but really just part of an overall mild correction, I believe, at this stage. The only overrider to that is if the situation in Greece deteriorates further. And that certainly is something that's potentially weighing on the markets. But other than that, I'm not really seeing any indication that the recent high that we saw up at 1422 being other than just a normal corrective phase, because the market has got a little bit of ahead of itself. So Greece is the wild card, but putting that aside, then I believe that this is just a normal garden variety correction. We'll have a look at some charts, but certainly the US banking index, the Russell 2000, the small to mid cap stock index, the VIX has kicked up a little bit, but really it's only barely over 20, so it's not really indicating much in the way of fear or people out there taking out insurance. Copper, there wasn't too much movement either, so really not anything really untoward at this stage. The ASX 200, however, did take fright, as we often do, and lost 111 points on the week. So that was fairly significant. And what was even more significant is the fact that we now may have had a false break of that range. If you remember that we had a ceiling at 43.50, which got tested 10 times before it eventually broke. We've now moved very emphatically back into that range, and technically that's a very bad sign. So I would think it's highly likely that we're going to see some lower prices for at least a short period. The small cap sector is really pretty dead at the moment. The momentum has been completely lost. The volumes have gone away. There's no dramatic sell-off there, but equally there is inadequate volume to cause the prices of stocks to be sustained. So I believe the only way that we're going to see some progress will be announcement driven. It's not going to be momentum as we saw in the first 3 to 3.5 months of this year. So most stocks at the moment are basically sideways to down and on pretty low liquidity, and that seems to be the dynamic that's playing out at the moment. Let's have a look at the S&P and the other main indices. This is the pattern that I'm now seeing. We had an A leg down, so we're in my overall premise is that we're in an overall larger move higher at this stage. Now, I may need to change that, but that is the premise at the moment. We've had one leg higher. We're now in the process of correcting that. So we've had an A leg to the downside. We've had a B leg bounce to a high of 1422. And we're now in the progress of getting a bit more of a correction to finish that to the downside. I'm looking at 1340 or 1320 as the target. We're now getting down to the reasonably oversold. Every time we've got down to this level of late, in fact we're actually lower than two previous levels. So we generally see a market bounce from there. So as I said, unless Greece falls off the rails, then I would expect a similar sort of thing to play out. And to back that up, let's look at the US banking index. It's basically near its all-time highs since this index has been tracked. So you can see that wouldn't be happening if we had an impending major top in the market. In fact, the banking index actually went up last week. If we look at the Russell 2000, you can see it's really just in a trading range. It has lost a little bit of ground in the last couple of months, but if we were at a major top, the Russell would be down here closer to 700, certainly in the low 700s, not up in a similar area to where it's been all year. And if we look at the VIX index on the S&P 100, yes, it's kicked up a little bit in the last couple of weeks, but it's still only a fraction over 20, and that is not the sort of area that's indicating a significant problem. I would have thought closer to 30 would have been the go if we were going to get a more major move to the downside. So that's my view at the moment. Let's have a look at the Aussie 200. As you can see, we had a very, very major resistance level that had been tested many, many times here at 43.50. We eventually broke it. We stayed above it for a couple of weeks, but then we came back into the range very emphatically. Look at this day on Monday the 7th of May when we were down by 95 points. And when prices emphatically fail a significant support level as this would have become or should have become, then I would expect that we will see some more downside. So don't be surprised to see another 100 to 200 points come out of the Australian market over the next few weeks or few months. Now, it could do it in a very mild way, so it doesn't mean there's any need to panic. It could be quite just a mild slide more than anything else, but it would be highly unusual for the index to just head back up again and break through that 43.50 level. So I'm really not expecting much upside at the index level for a little while. Okay, let's have a look at gold. It also had a pretty bad week last week, down $66, and worryingly from my point of view, it dropped below the long-term trend line, closed on its lows, and it also dropped out of the consolidation triangle. So that was very disappointing, but when markets do those things, you just have to adjust your thinking and respond accordingly. So I'm not quite sure where gold is going at the moment. We could see a little bit lower. There's support at 1550, so we'll have to see how it holds around that level. The US gold mining indices, the GDX and GDXJ, still trying to find a bottom in the market. They've been incredibly disappointing. But I can tell you that these gold businesses are in far better shape than they were at the end of the GFC. They're just as cheap as they were at the end of the GFC. So this makes absolutely no sense. And I'm almost positive it will turn around at some point because markets can remain irrational for periods of time in the short term, but ultimately investors will look at these gold stocks and see them trading on incredibly low valuations, will see them paying dividends, and will start to regard them far more favourably than they do at the moment. So I believe it's just a matter of time. Gold stocks also almost always bottom before the rest of the market. Gold stocks and perhaps to a degree technology stocks tend to turn up before anything else, particularly in the States. And I would expect to see a similar sort of thing this time. Now oil was a bit lower on the week. We had Brent crude down by another $4, so oil has been on the slide now for a few weeks. And light sweet crude continued its slide and was down at $96. Copper fell back below $3.80, which is not really what I want to see, so that's not particularly helpful for resource stock sentiment either. Copper could go either way, but looking at it, I suspect it's a bit more suspect than it was a couple of weeks ago. And here's a chart of copper over the last 6 months. You can see that we had held a range above 370 for some time. We dropped below that range, we recovered, and now it's heading back down again. So if I had to pick a direction, I think we might see a bit more downside in copper yet. Let's just have a look at a few other charts. So this is the weekly gold chart. You can see there was a very clear trend line support which started at just under $700 back in October of 2008, and we had been holding that trend line support for about 4 or 5 weeks. I was expecting this to move to the upside because the fundamentals to me are overwhelmingly in favour of gold moving higher, but instead we dropped out of that consolidation triangle. We also dropped below that trend line. The support down here at 1550, I hope that holds. If it doesn't hold, then I'm not quite sure where gold goes from there. Perhaps then we could see gold down more like the 1450 area. But that was quite definite, so that is a bit concerning for gold and for gold stocks. Let's have a look at the GDX, put it on a weekly chart. So clearly still in downtrend, has been now for some time, since basically early March. So about 8 weeks now of concerted downtrend. It's oversold, but we just haven't seen a turnaround as yet. Let's look at the juniors. Junior index similarly been in a significant downtrend now for some time. Again, oversold, so it can turn around at any point, but really not showing any signs of a bottom at this stage. So just a few thoughts on overall strategy in terms of how you should be positioned. The S&P index, 1320 remains the likely target in my view. With respect to Aussie stocks, unless you're a longer term trader, and I'm talking 6 to 12 months and above, so that you can sit there and you're comfortable sitting through some more downside, my view is if you don't have short exposure, if you don't short sell the market as part of your trading practice, then you really should have very little exposure at all, because it's hard to see what's really going to drive stocks upwards in the short term, other than the odd specific stock announcement situation. Small caps in general, pretty much no-go zone for now, I believe. The risks are all to the downside. I can't see anything that's going to drive them to the upside, and any significant events in Europe could cause a real sentiment sell-off. So the risk and reward about small cap trading at the moment is just not there. And that's the reality. I mean, that happens several times a year. The small caps go well for a few months and then they dry up, and you really just need to pull back and wait for that period to come back in again. In terms of overall exposure, these comments I've been consistently saying now for something like 4 to 6 weeks. You should be holding plenty of cash to buy good opportunities, because they will come. You certainly should be looking at better quality stocks. I wouldn't be trading the small speculative exploration stocks. And you should be increasing your short side exposure if that's something that you typically do. So remains a time to be careful. The members of Specialist Share Education have got a lot of short stocks open at the moment. They're all working for us, and that's just the reality of the market at the moment. So that's the update for this weekend. Talk to you next weekend. Cheers. If you want to trade and invest with us with a big edge on the market, go to our website, specialistshareeducation.com.au. You can access our free video series on creating trading cash flow and smart investing. Plus, you may also register for our weekly Ask the Expert webinar.